Your trading account is small, and that might be the best thing that can happen to you as a trader. Because when your account is small, the biggest mistake you can make is trying to make it big quickly. That mindset pushes traders into oversized positions, unnecessary risks, revenge trades, and eventually blowing everything they worked for. Mark Douglas understood something that most traders learn only after losing money. Your job isn't to make a fortune from one trade. Your job is to become the kind of trader who can consistently execute an edge. So in this video, we're going to break down why trading small can actually help you win big over time, and why the way you think about your small account may be more important than the amount of money inside it. If you find this valuable, make sure to like the video, share it with another trader who needs to hear this, and subscribe to the channel for more trading psychology. The problem begins when a trader looks at their account balance and feels that it is too small to matter. Imagine looking at a $500 account and thinking, even if I make 5% this month, what difference is that going to make? That thought seems harmless, but it can quietly change the way you trade. Instead of focusing on making good decisions, you start focusing on how quickly you can turn that small amount of money into something meaningful. You see a $500 account and imagine $5,000. You see a $5,000 account and imagine $50,000. And suddenly, the normal returns of a disciplined trader feel too slow. That is where excessive risk begins. You start thinking that risking 1% is pointless because 1% of a small account doesn't feel like real money, so you increase the position. Maybe you risk 5%, maybe 10%. You tell yourself that you are willing to accept the risk because the account is small anyway. But there is a psychological trap hidden inside that thinking. You are no longer trading your strategy, you are trading your desire to escape the small account, and those are two completely different things. When you desperately want the account to grow, every trade starts carrying more emotional weight. A loss doesn't feel like a normal outcome anymore. It feels like you're moving backwards. A missed setup doesn't feel like part of trading anymore. It feels like you just missed an opportunity to make money. And because the account is small, you begin believing that you need something big to happen. You need a big winner. You need several winners in a row. You need to catch the perfect move. You need to make enough money to finally feel like you're getting somewhere. But the market doesn't care how much money you have in your account. It doesn't know that you're trying to grow a $1,000 account. It doesn't know that you want to make $10,000 this year. It doesn't know that you need this particular trade to win. The market only gives you probabilities. And once you understand that, you begin to see why excessive risk is so dangerous. The smaller your account feels to you, the more tempted you may become to make every trade bigger. But the solution isn't to take more risk. The solution is to change what you're trying to accomplish. Your first goal with a small account shouldn't be to make a lot of money. Your first goal should be to prove that you can follow your rules when money is on the line. Because if you cannot control yourself with a small account, giving yourself a larger account won't solve the problem. It will simply make your mistakes more expensive. The desire to double a trading account quickly creates another dangerous problem. It changes the way you measure success. Instead of asking yourself, did I follow my trading plan? You start asking, how much money did I make today? And once money becomes the main measure of success, discipline becomes much harder to maintain.
Think about what happens when a trader decides that they want to double a small account in a short period of time. They immediately create pressure for themselves. If the account is $1,000, doubling it means reaching $2,000. Now imagine the trader has a strategy that normally gives them a few good opportunities each month. Those opportunities might be enough to produce steady returns over time, but they don't feel fast enough anymore. So the trader starts looking for more trades. A setup that normally wouldn't qualify suddenly looks good enough. A trade that they would normally skip becomes tempting. They enter earlier. They increase their position size. They risk more than their plan allows. And sometimes they even start trading markets or sessions they don't normally trade simply because they feel they need more opportunities. The interesting thing is that the strategy itself hasn't changed. The market hasn't changed. What changed is the trader's expectation. They are no longer satisfied with executing their edge. They want the account to move. And that creates a conflict between discipline and urgency. Discipline says, wait for your setup. Urgency says, I need a trade. Discipline says, risk the amount you've planned. Urgency says, if I risk more, I can reach the target faster. Discipline says, accept this loss and move on. Urgency says, I need to make that money back. This is how a simple goal like doubling a trading account can slowly turn into emotional trading. And the most dangerous part is that sometimes it actually works. You might take excessive risk and get lucky.
You might double the account. You might even triple it. And that can make the behavior even more dangerous, because now your brain has evidence that the reckless approach can work. You start thinking, maybe I was right to take that risk. But you weren't necessarily right. You were lucky enough to get a favorable outcome from a risky decision. Those are not the same thing. A bad decision can produce a profit. A good decision can produce a loss. That's one of the hardest lessons in trading psychology. If you judge yourself only by the result of one trade, you can accidentally reward bad behavior. And that's exactly what happens when a trader becomes obsessed with doubling the account. They stop training themselves to become disciplined and start training themselves to chase outcomes. Eventually, one loss can create frustration, another loss can create fear, and after enough emotional pressure, the trader begins breaking the very rules that were supposed to protect the account. This is why the speed of your account growth can sometimes be less important than the quality of the trader you are becoming. Because imagine you have a small account and you spend a year learning how to risk properly, wait for your setups, accept losses, control your emotions, and follow your plan even when you're bored. Your account may not look impressive, but something far more valuable has been growing underneath it: your ability to execute. And that ability can eventually be applied to a much larger account. On the other hand, imagine you double a small account quickly by taking huge risks. You haven't necessarily developed a skill. You may have simply developed confidence in taking excessive risk. And when the account becomes larger, that same behavior can become extremely expensive. The goal isn't to prove that you can double an account quickly. The goal is to become the kind of trader who doesn't need to. Because once you stop demanding that every trade make a big difference to your account, you can finally start treating each trade as what it really is: just one outcome in a long series of trades. There is a huge difference between making money in trading and becoming a consistent trader. And if you don't understand that difference, a winning period can actually become dangerous. Anyone can make money in the market for a while. You can have a few winning trades in a row. You can catch a big move. You can take a trade with too much risk and get lucky.
You can even double a small account without having a real understanding of what you're doing. But making money is an outcome. Consistency is a skill. A trader who makes money today isn't necessarily a good trader. The real question is, can you make good decisions repeatedly, even when the market doesn't give you the result you want? That's where trading becomes much deeper than simply finding entries. A consistent trader understands that every trade is uncertain. They don't need the next trade to win. They don't need to recover the last loss. They don't need to make money every day. They understand that their edge only has meaning across a large number of trades. So when they lose, they don't immediately question everything. They don't suddenly double their risk. They don't start looking for another trade just because they want their money back. They simply accept that this particular outcome was part of the game and wait for the next opportunity. This is very different from a trader who is focused only on making money. When making money becomes the main goal, every outcome becomes personal. A loss feels like failure. A missed trade feels like wasted money.
A winning trade creates excitement and can make the trader feel invincible. And after a few wins, they may start increasing their risk because they believe they've figured the market out. Then one loss comes along and takes away a large part of those gains. The trader becomes emotional, tries to recover, and the cycle continues. A consistent trader thinks differently. They understand that their job isn't to predict every movement. Their job is to execute their strategy when the conditions they have defined are present. That's it. They can have a losing week and still know they did their job correctly. They can have a winning week and still recognize that they made mistakes. That is a completely different way of measuring performance. Instead of asking, "How much did I make?" they begin asking, "Did I follow my process?" That question changes everything. Because if you follow a sound process over and over again, the results have room to take care of themselves. But if you focus only on the result, you can make terrible decisions as long as those decisions happen to make money. And that's one of the biggest traps in trading. Imagine a trader risks 5% of their account on a trade that only fits their strategy partially. The trade wins. They make money. If they judge themselves only by the result, they may think they did something right. But what happens when the same decision loses? Now they may feel angry and blame the market. The problem wasn't the loss. The problem was the decision. A consistent trader learns to separate those two things. They understand that a good trade can lose and a bad trade can win. That means the quality of your trading cannot be measured by the result of one trade. It has to be measured by the quality of your decisions over time. This is why a small account can be so valuable. It gives you an opportunity to practice the mental side of trading before the money becomes significant. You can learn how to sit through uncertainty. You can learn how to accept losses. You can learn how to wait. You can learn how to stop trading when your rules say to stop. You can learn how to remain calm after a winning streak. You can learn how to continue following your plan after several losses. And those skills are worth far more than quickly turning a small account into a large one.
Because eventually, if your capital grows, your psychology has to grow with it. A trader who learns consistency first can gradually increase capital without changing who they are. But a trader who learns to chase money first may carry the same emotional habits into every larger account they receive. And the larger the account becomes, the more expensive those habits become. So don't confuse a profitable month with consistency. Don't confuse a winning streak with skill, and don't confuse a growing account with personal growth as a trader. The real achievement isn't simply making money. The real achievement is becoming someone who can execute the same process again and again, regardless of whether the last trade won or lost. Because once you become consistent, money stops being something you have to chase. It becomes a possible result of doing the right things repeatedly. When your account is small, risking a small percentage can feel almost pointless. You look at the numbers and think, if I only risk 1%, how long is it going to take before this account becomes meaningful? That question is understandable. But this is where many traders make a serious mistake. They look at the amount of money they can make instead of looking at what they are training themselves to become. If you risk 1% on a $1,000 account, you're only risking $10. $10 might not feel important. You might think, I'm never going to change my life making $10 on a trade. And you're right, but that isn't the purpose of the $10. The purpose is to learn how to make decisions correctly while real money is at risk. Because trading is not only about how much money you have.
It's about how you behave when you have something to lose. If you can follow your plan while risking a small amount, you are building something much more valuable than a quick profit. You're building consistency. You're teaching yourself that you don't need to know what the next trade will do. You're teaching yourself that one loss doesn't require revenge. You're teaching yourself that missing a trade doesn't mean you need to chase the market. You're teaching yourself that you can remain patient even when nothing is happening. And these lessons become incredibly important when the account gets larger. Imagine that you eventually have a $100,000 account. If you developed the habit of risking 1%, that same 1% is now $1,000. The percentage didn't change. Your psychology has to handle a larger amount of money, but the underlying risk structure remains the same. Now compare that with someone who started with a small account and constantly risked 10 or 20% because they felt 1% was too small. They may have made money quickly, but they also trained themselves to believe that large risk is normal. When their account becomes larger, that habit doesn't automatically disappear. 10% of a $100,000 account is $10,000. Suddenly, the same behavior that felt exciting with a small account becomes extremely painful. This is why your small account isn't an excuse to ignore risk management. It's actually your training ground. The amount of money may be small, but the habits you're developing are not. And there is another reason small risk matters. When you risk too much, you become emotionally attached to the outcome of every trade. You start watching every candle. You start hoping. You start praying that price doesn't hit your stop. You might move your stop because you can't accept the loss. You might close a winning trade too early because you're afraid of giving the profit back. You might enter another trade immediately after a loss because you want to recover the money. Now your trading decisions are being controlled by fear and greed instead of your strategy. But when your risk is small enough, it becomes easier to think clearly. You can accept that the trade might lose. You can let the setup play out. You can walk away after the trade is placed.
And most importantly, you can experience losing without feeling like you have to do something about it. That's a major psychological advantage. A professional mindset isn't built by making every trade important. It's built by making every individual trade relatively unimportant. Your edge matters over a series of trades, not because one particular trade has to work. So if your account feels too small, don't automatically respond by increasing your risk. Ask yourself a different question. What am I trying to build here? If you're trying to build a gambling habit, then taking huge risks might give you the excitement you're looking for. But if you're trying to build a trading career, then your small account is giving you an opportunity to practice the habits that you'll need later. You don't need to make your small account feel big. You need to make your small account teach you how to handle a bigger one. Because the goal isn't to grow the account as fast as possible. The goal is to grow the trader first. And when the trader becomes disciplined, patient, and consistent, the amount of capital they manage becomes far less important than the process they use to manage it.
Impatience is one of the quietest forces that can destroy a trader. It doesn't always appear as anger. Sometimes it looks like excitement. Sometimes it looks like ambition. Sometimes it sounds like, I just need to make a little more today. But underneath all of these thoughts is the same problem. You don't want to wait. And trading is built around waiting. When you have a small account, impatience becomes even more dangerous because you already feel like you're behind. You look at the account balance and imagine where you want it to be. You see other traders talking about their profits. You watch a market move without you. You see a setup that you missed, and suddenly doing nothing feels like you're losing money. That is where FOMO begins. The market moves without you, and instead of accepting that the opportunity is gone, you start thinking, maybe I can still catch it. So you enter late. The original setup is no longer there, but you don't want to miss the move. Price moves against you. Now you're in a trade you weren't supposed to take. You take the loss, and instead of accepting it, another thought appears. I need to make that back. Now you're no longer trading your setup. You're trading your previous mistake. You look for another opportunity immediately. Maybe you increase your position. Maybe you lower your standards. Maybe you take a setup that you would normally reject. And this is how revenge trading begins. One emotional decision creates another. The first mistake might have been entering because of FOMO. The second mistake is entering because you want to recover. The third mistake is increasing risk because you're frustrated. And before you realize what's happening, you aren't following a trading plan.
You're trying to repair an emotional situation with another trade. The market becomes the place where you're trying to fix how you feel. But the market cannot fix your emotions. It can only expose them. This is why impatience is so dangerous. It makes waiting feel like doing nothing. But waiting is not doing nothing. Waiting is part of the job. If your strategy requires a liquidity sweep, you wait for the liquidity sweep. If it requires a particular market structure, you wait for that structure. If there is no setup, there is no trade. It doesn't matter how badly you want the account to grow. It doesn't matter how long you've been waiting. It doesn't matter that you haven't taken a trade for several days. The market doesn't owe you an opportunity, and you don't need to create one. Sometimes the best trade you can take is the trade you refuse to take. Because every time you avoid a low-quality setup, you're protecting your capital and reinforcing discipline. And every time you chase a setup because you're afraid of missing out, you're teaching yourself that your emotions are allowed to override your rules. That habit becomes dangerous over time. The trader who constantly reacts to missed opportunities eventually creates their own losses. They don't lose because the market forced them into a bad trade. They lose because they couldn't accept that the opportunity had already passed. And this is where patience becomes more than simply waiting. Patience is the ability to accept that you don't control when your edge appears. You only control what you do when it does appear. You might wait for days and finally get your setup. You might take the trade and lose. That's still okay, because your job was never to guarantee the outcome. Your job was to execute correctly. And once you truly understand that, revenge trading and FOMO start losing their power. You stop feeling like every missed trade needs to be replaced. You stop feeling like every loss needs to be recovered immediately. You stop treating the market like something that must constantly give you money. You become comfortable waiting. And that comfort is a powerful advantage, because the market will always provide another opportunity. But you have to be disciplined enough to still be there when it comes.
Your job as a trader is not to make money on every trade. Your job is to execute your edge. That sounds simple, but it completely changes the way you approach the market. An edge doesn't mean that your next trade will win. It means that when your setup appears under the right conditions, you believe that taking that trade repeatedly gives you a positive expectation over a large enough sample. That's all you have. You don't have certainty. You don't have control over the next candle. You don't know whether the next setup will be a winner or a loser. And the moment you accept that, you stop demanding certainty from the market. This is where many traders go wrong. They think their job is to predict what price is going to do, so they enter a trade and start hoping. They want price to move in their direction because they need the trade to make money. But the market doesn't care what you need. Your account balance doesn't influence price. Your emotions don't influence price. Your confidence doesn't influence price. Your fear doesn't influence price. So trying to force a profit is pointless. You can only control the quality of the decision you make. Imagine you have a setup that has worked consistently for you over a large number of trades. You follow your rules, the setup appears, you take the trade, and it loses. Was that a bad trade? Not necessarily. If you followed your plan and accepted the predetermined risk, you may have executed a perfectly good trade that simply produced the losing outcome this time.
Now imagine the opposite. You see a setup that doesn't meet your rules. You enter anyway. You take excessive risk, and the trade wins. Was that a good trade? No. It was a bad decision that happened to produce a good outcome. This distinction is extremely important, because if you judge your trading only by money, you can accidentally reward bad behavior. You can start believing that breaking your rules is acceptable whenever it produces a profit. Eventually, that behavior catches up with you. A consistent trader judges themselves differently. After every trade, they can ask, "Did I execute my plan?" Not, "Did I make money?" That question removes a huge amount of emotional pressure, because now a loss doesn't automatically mean you failed, and a profit doesn't automatically mean you succeeded. Your success is measured by your execution. This is especially important when you're trading a small account.
You might look at your balance and feel pressure to make it grow, but if you allow that pressure to control your decisions, you'll start forcing trades that aren't there. You'll enter because you haven't traded recently. You'll increase risk because your last trade lost. You'll take a setup that is almost good enough because you don't want to finish the day without a trade. And slowly, your strategy becomes secondary to your need for a result. That's when trading becomes emotionally exhausting. But when you focus on executing your edge, something changes. You become comfortable with uncertainty. You understand that your edge needs a sample of trades to reveal itself. You can lose 3 trades in a row and still follow your plan. You can win 3 trades in a row and still keep your risk unchanged. You can sit out when there is no setup without feeling guilty. You stop trying to force the market to pay you. And ironically, this is when you give yourself the best chance of becoming profitable. Because profits cannot be forced, they can only emerge from a process that is executed consistently over time. Your responsibility is the process. The market decides the outcome. And once you genuinely accept that relationship, trading becomes much simpler. You stop trying to control what cannot be controlled. You focus on what is actually in your hands.
Your risk, your patience, your entries, your exits, your discipline, your ability to walk away, and your ability to take the next valid setup without carrying the emotional weight of the previous one. That's what it means to execute your edge. You are not trying to win the next trade. You are trying to make the right decision over and over again. Because a trader who needs every trade to make money will eventually force trades. But a trader who only needs to execute their edge can remain calm through both wins and losses. And that is the mindset that allows consistency to develop. A small trading account can teach you something that a large account cannot teach you as cheaply: how to control yourself. When the amount of money is small, you have the opportunity to practice the mental side of trading without putting a large amount of capital at risk. You can learn what it feels like to take a loss and do nothing about it. You can learn what it feels like to watch a setup move without you and resist the urge to chase it. You can learn how to sit through a winning trade without becoming greedy. You can learn how to take several losses in a row without changing your strategy. And these experiences are building something much more important than the account balance. They're building your identity as a trader. Because eventually the numbers can become much larger. A 1% loss on a $1,000 account might be $10. A 1% loss on a $100,000 account is $1,000. The percentage is exactly the same, but emotionally the experience can feel very different. That's why the psychology needs to be developed before the money becomes large. You don't want your first experience of serious financial pressure to happen after you've already received a large account. You want to have already trained yourself to think in probabilities, respect your risk, accept losses, and follow your plan. A small account gives you that training ground. It allows you to discover your weaknesses. Maybe you notice that after 2 losses you become impatient. Maybe you realize that after a big winner you start increasing your risk. Maybe you notice that when you haven't taken a trade for several days you start lowering your standards. These are not small problems.
They're clues about the psychology you'll need to fix before managing larger capital. And this is why the small account shouldn't be viewed only as a vehicle for making money. It can be viewed as a training environment. Every trade gives you information about yourself. A losing trade can teach you how you respond to disappointment. A missed trade can teach you how you respond to FOMO. A winning streak can teach you how you respond to confidence. A period with no setups can teach you how you handle boredom. The money may be small, but the lessons can be enormous. And if you learn those lessons now, you won't have to learn them when every mistake costs hundreds or thousands of dollars. This is also why increasing your account size before you're psychologically ready can be dangerous. Imagine a trader who constantly breaks their rules on a $1,000 account. They overtrade, they revenge trade, they move their stop, they increase their risk after losses. Then somehow they get access to a $100,000 account. Did the traders suddenly become disciplined because the account became larger? Of course not. The capital increased, the psychology didn't. And now the same mistakes have a much larger financial consequence. The real goal of trading a small account is therefore not simply to make the account bigger, it's to make yourself better. You want to reach a point where your behavior doesn't depend on whether the account is $1,000, $10,000, or $100,000. Your risk management remains consistent. Your patience remains consistent. Your standards remain consistent. Your reaction to losses remains consistent.
Your reaction to winning remains controlled. That is what makes scaling possible. Because scaling isn't simply adding more money, it's taking the same disciplined process and applying it to more capital. If your process works only when the numbers are small, you haven't really solved the psychological problem. You need to become comfortable making the same decisions regardless of the size of the account, and that takes practice. You need to experience uncertainty again and again. You need to lose without panicking. You need to win without becoming reckless. You need to wait without feeling like you're missing something. You need to accept that sometimes the best decision is no decision at all. Those experiences slowly change the way you see trading. You stop seeing every trade as an opportunity to make money. You start seeing every trade as another opportunity to execute correctly. And that shift is powerful. Because when the account eventually becomes larger, you don't want to suddenly become a different person. You want the larger account to be managed by the same disciplined trader you developed when the account was small. So don't underestimate your small account. It may not be giving you the money you want yet, but it can give you something much more valuable. It can give you the psychology required to handle the money you want later. Build the trader first. The capital can come after.
One of the most dangerous thoughts a trader with a small account can have is, "This account is too small for me to care about 1 or 2%. It sounds harmless, but that thought can slowly change the way you manage risk. You look at your account balance and decide that losing a small amount isn't important. So you increase your position size. You risk a little more than your plan allows. Then you do it again. And because the account is still small, the consequences don't feel serious. That is the trap. You're not just changing the amount of money you're risking, you're changing your relationship with risk. When you repeatedly take larger risks because the account feels insignificant, you're teaching your brain that breaking your risk rules is acceptable when the money isn't large enough, and that habit doesn't disappear when the account gets bigger. It follows you. A trader who becomes comfortable risking 5% on a small account may eventually carry that same behavior into a much larger account. The numbers become bigger, but the behavior remains the same. And suddenly, what once felt like a small risk becomes a serious financial loss. This is why risk management should be based on percentage and not on whether the amount of money feels impressive. If your trading plan says you risk 1%, then 1% is 1%. It doesn't matter whether that 1% is $10, $100, or $1,000. The purpose of the percentage is to keep your behavior consistent. The purpose of the percentage is to keep your behavior consistent. Because your account balance can change. Your emotions can change. Your confidence can change. But your risk rules should remain stable. There will always be moments when 1% feels too small. You might look at your potential profit and think, what's the point? But that question reveals something important. You're starting to measure trading by how much money you can make from each trade, rather than by how well you execute your strategy. And once you start thinking that way, the temptation to increase risk becomes stronger. You want every trade to matter. You want every winning trade to move the account significantly. You want to look at the balance and feel that you're making progress. But professional trading doesn't require every trade to make a noticeable difference. In fact, you want the opposite. You want each individual trade to be small enough that you can accept the outcome without losing control of yourself. Because if one trade can emotionally destroy you, the risk is probably too large. If one loss makes you desperate to recover. If one missed trade makes you chase the market. If one winning trade makes you increase your position. Then the problem isn't the market. The problem is that the trade has become too important to you. And when a trade becomes too important, your decision-making becomes emotional. You stop thinking in probabilities. You start thinking about money. You start thinking about what you could buy with the profit. You start thinking about how much you lost. You start thinking about how quickly you need to recover. And the moment those thoughts take over, your trading plan becomes much easier to break.
This is why a small account should be treated with respect. Not because the amount of money is large, but because the habits you develop with that money can follow you for years. If you learn to respect 1% now, you are building a habit that can protect you later. If you learn to accept small losses now, you'll be better prepared to handle larger losses later. If you learn to keep your risk unchanged after a winning streak, you'll be less likely to become reckless when your confidence increases. And if you learn to keep your risk unchanged after a losing streak, you'll be less likely to revenge trade when you're frustrated. The goal isn't to make a small account feel important. The goal is to make the process important. Your account may be small today, your profits may be small today, but your discipline doesn't have to be small. Because the trader you become while managing a small account is the trader who will eventually manage a larger one. So don't increase your risk just because the balance feels insignificant. The money might be small, but the habits you're building are not. Protect the account, protect your discipline, and most importantly, protect the trader you're becoming.